IUL does not dwarf whole life insurance. IUL has at least 12 problems with it. Today we're going to look at the top 3 problems of IUL. Here's why IUL does not dwarf whole life insurance. The first reason we're looking at today as to why IUL does not dwarf whole life insurance is because of surrender charges. IUL has surrender charges, 10 years, 15 years, sometimes longer. We are going to look at real-life IUL examples. Here's the first IUL company we'll look at to show surrender charges. When the $12,000 premium goes in, what's available in first-year cash value is zero. There is $8,300 of accumulation value, but because of surrender charges, there's no money available. And this policy has 12 years of surrender charges. In this next IUL example, we see that when the $140,000 first-year premium goes in, the net surrender value is $68,000. Accumulated value is $123,000, but far less of the premium is available in cash value. This policy has 10 years of surrender charges. In our next IUL example, when the $6,000 a year premium goes in, the cash surrender value is zero. High surrender charges. This particular policy has 15 years of surrender charges. In our next example, when the $84,000 first year premium goes in, $0 of that is available because of surrender charges. And this policy has 10 years of surrender charges. In this IUL example, when the $50,000 premium goes in year 1, cash value because of surrender charges is only $26,000. In our last example, when the $12,000 a year premium goes into this IUL, the surrender value is zero for year 1. And this policy has 15 years of surrender charges. Surrender charges don't allow you to access your total cash value. And as you can see, those surrender charges can last 10 years, 15 years, and in some IUL cases, even longer. Whole life insurance does not have surrender charges. The next problem with IUL are the increasing costs. As you get older, the costs go up. You may have to pay more premiums than you thought to keep the policy active, or if you don't pay higher premiums, you'll find that the insurance company will take those premiums from your cash value, and you'll begin to see your cash value erode and eventually or potentially go to zero. The way we see those increasing costs in IUL is in the guaranteed scenario. Always look at your guaranteed scenario. The reason, the guaranteed scenario shows the impact of increasing insurance costs and other costs that go up as you get older. Notice on this illustration that the $12,000 is funded for 15 years, and starting year 16, there's no more premium going into the policy. At this point, the surrender charges are gone, and the high point of cash value is $114,000. But why does the cash value begin to erode in year 16 and eventually go to zero after age 74? It's because of increasing insurance costs. We also see here in the illustration policy charges. Notice they increase every year as you get older. Those increasing costs will always be with you. In our next IUL example, here we see guaranteed interest. The high point of cash value is $1,002,000. We see eroding cash value, and eventually at age 59, there's a lapse. Why? Because of those increasing costs. In this IUL example, the guaranteed assumptions show how the increasing costs erode cash value. We see the high point, $10,700, age 71, cash and death benefit are eroded to zero. And specifically in the illustration, rider charges, cost of insurance, increasing over time. Before you purchase an IUL, look at the guaranteed values, look at the costs in the illustration. And if the illustration doesn't show the costs, ask for the pages that show the costs. Whole life insurance does not have increasing costs in the base whole life premium. The final problem with IUL we're looking at today is unrealistic returns. That the illustrated rate shown in the IUL is unrealistic. That the IULs do not perform as illustrated. In this IUL example, they're showing an earnings rate of 7.08% every year, as if you're going to earn that year in and year out without ever having a losing year. That's not how the market works. The market doesn't earn 7.08% every single year. There's volatility. We know some years there are going to be losses, some years it will be higher than 7%. The problem with the IUL illustrations that we're looking at today is none of them take into consideration in the non-guaranteed values any market volatility, and that's completely unrealistic. The market is going to lose money, and the illustrations do not show that in the non-guaranteed values. They only show you earning 7.08% for the rest of your life, which is impossible, and it's completely unrealistic. So if we take that 7.08% return that's used in the current scenario, this policy was funded at $12,000 a year for 15 years. $180,000 went in, no more premiums thereafter. We're going to look at two numbers. We're going to look at the total cash value in year 15 and calculate what rate of return that is. Here's our 15 years, 7.08%. $12,000 a year. There should be $324,000 in the policy, but what we see is $227,000. Now, to be fair, there are some charges, and even in a high cash value whole life policy, there are some charges. But remember, the base premium of a whole life policy does not have increasing insurance cost. It's a fixed level cost. You never have to worry about eroding cash value in a whole life policy. Let's run this out to age 90. 1.6 million in total cash value. That's 45 years. And in year 16, there was no more premium going into the policy. What should be available in cash value? $2,529,000. But what do we see in the illustration? $1,607,000. If we do the math, $2,529,000 minus $1,607,000, what happened to $918,000? Where did it go? If the illustration shows 7.08%, where's the rest of the money? And why doesn't the IUL perform the way that it's illustrated? In our next IUL example, the current interest rate shown is 6.64%. And notice, 100% of this is going to the S&P 500 index. In 19 years of funding, $84,750, cash value is $2.69 million. When we do the math on this, using the calculation, 19 years, 6.64%, cash value, $3.25 million is what should be in the policy. The difference, $557,000. Again, where did that money go? We have to look at increasing insurance costs, increasing policy charges, and unrealistic returns. The IUL is not going to earn 6.64% or 7% or 8% every single year. There is going to be market volatility. Even this number we see of 2.699 million isn't accurate. Why? Because the market doesn't perform positively every single year. But in the IUL illustrations, that's what they assume, that you are going to make money every single year. And that isn't true. Some of you might be thinking, well, Barry, 6.64% is an average rate of return. An average rate of return is meaningless. I'm going to get to that in a minute. What does 2.69 million actually translate to? I come back to the calculator and I pop in 4.94%. There's our 2.69 million. So the illustrated non-guaranteed value is really 4.94%. But even this is misleading. Why? Because the policy is not going to earn 4.94% every single year. For those of you saying, well, Barry, it is an average rate of return. Some years are going to be higher, some years are going to be lower. Let me share with you what average really means. I've titled this calculator Average versus Actual. They put in $50,000 and in year one, they have 100% return. They turn their $50,000 into $100,000. But in year two, they lose 50%. They're back down to the same $50,000 they started with. Year three, they have another stellar year. They earn 100% return, back to the 100. And finally, in year four, they lose another 50%. Now, what's so interesting about this is their financial advisor or their quarterly or annual statement would show them that they earned an average rate of return of 25%. But their actual rate of return is zero. 4 years have gone by. They have the same $50,000 they started with. The math shows an average rate of return of 25%. But we all know, looking at the numbers, when you put real money into earnings, the actual return here is zero. An average return is meaningless. You have to put real money into it. And there's a name for this. It's called sequence of returns. You have to factor in the sequence of returns, that when you lose 50%, it takes much more than 50% just to get back to even. If you lose 50% in 1 year, you can't just have a 50% return in year two to get back to even. That only puts you at 37,500. You have to have 100% return just to get your money back. Average rates of return are meaningless. You must look at actual returns. And in an IUL, there are multiple problems with these unrealistic returns. Not only do the IULs not perform as illustrated, but even the illustrated values are unrealistic because the market does not make money every single year. IUL does not dwarf whole life insurance. Why? Because of all the reasons we've talked about, plus many others. You know more now about IUL and the problems with IUL than most insurance agents out there. Most agents don't understand the full problems of surrender charges, increasing costs, and the unrealistic returns. Whole life, on the other hand, does not have surrender charges, increasing base premium costs, nor does it have unrealistic returns. So let's look at a couple real life, high cash value whole life examples. When looking at whole life insurance, always look at a properly structured high cash value policy to maximize your gains and to maximize your cash value growth. In this first high cash value whole life example, we have a total premium of $50,000 a year. Notice the non-guaranteed values that include the dividend show $39,000 of total cash value. There are no surrender charges. You can access up to 95% of cash value in any year. You also notice, based on the guaranteed values, there are no increasing costs that are going to erode cash value. This column right here, total cash value, it doesn't matter how old the person gets. We see this over and over. Cash value is always increasing, even into this person's 80s and 90s and well over 100. Cash value is always guaranteed to grow in a properly structured whole life policy. And what about the rate of return? The whole life policy does what it says it's going to do. We'll use an example. At age 85, we're showing $7.34 million in cash value, and the earnings rate, 4.95%. Well, let's see if this illustration holds true, unlike the IUL examples we've looked at. This policy is funded at $50,000 a year for 20 years, and starting year 21, there is no more premium going into the policy. At age 85, you'll recall our number was 7.34 million. We take our time frame of 50 years, 4.95%, 50,000 a year for 20 years. Year 21, we go to 0. In 50 years, that cash value in fact grows to 7.349 million, just as we show in the illustration. And it's as if you would have earned 4.95% every single year without ever having a losing year. Remember, whole life insurance is not tied to the market. You get a guaranteed rate of return every year, no matter what's happening in the stock market. So you can rest assured this policy, as we see, earn 4.95% every single year for total cash value in 50 years of 7.349 million, exactly what is shown in the whole life high cash value illustration. Another option you have with a high cash value whole life policy, you can do a first year dump in where you put in a large lump sum. In this example, we're showing a $25,000 annual premium and a lump sum dump in of $60,000. Year one, contract premium is $85,000. If this was an IUL, you would have a very small portion of the $85,000 available because of the surrender charges. Because there are no surrender charges in a properly structured high cash value whole life policy, your net cash value in year one is over $81,000. The majority of your premium goes straight to cash value, not to insurance costs, not to surrender charges. This allows you to have more of your money available to use for policy loans, to go out and buy other assets, real estate, invest in your business. Cash is liquid, available to you. I teach you how to grow money tax-free, how to grow money guaranteed. I recommend you take a look at your own numbers. See what a properly structured high cash value whole life policy will do for you. Take that next step and look at your own numbers. To learn more and to see your own numbers, you can email me. You can visit the website, focuswealthgroup.com, or call the office. As we wrap up, IUL, as you can see today, does not dwarf whole life insurance. IUL is riddled with problems. We've only talked about the top 3 problems of IUL today. Properly structured high cash value whole life gives you predictability, certainty, guarantees, access to the majority of your cash value, and tax-free money now and in retirement if done correctly. Reach out to see your own numbers. I hope to talk to you soon.